Okay, so let's jump right into the heart of financial management. I want you to think of it like a three-legged stool. It absolutely needs all three legs to be strong and balanced, otherwise the whole thing just topples over. We're going to break down those three legs. These are the fundamental decisions that every single financial manager has to make, and they literally determine if a company soars or sinks.
But first, let's tackle a huge question, one you probably think you already know the answer to. When you picture a business, what's its number one goal? Making a profit, right? Well, yes and no. It's actually a little more sophisticated than that. So, look, profit is obviously important. But in the world of real financial management, there's a much more precise, more powerful objective that guides every single decision. And that is creating long-term value.
Think about it this way. On one side, you've got profit maximization. That's kind of like a sprint, you know? It's short-term, totally focused on the next quarterly report. But on the other side, you have wealth maximization. And that is the marathon. It's the long game. It's not just about the profit you make this year, but about increasing the entire value of the company for its owners year after year. This right here is the true north for financial managers. Every single choice, every decision is judged by one simple question. Does this increase the value of the owner's stake in our company? And that value comes from two places: the cash dividends they get in their pocket, and maybe even more importantly, the growth in the company's stock price over time.
So, with that big goal locked in, how do managers actually pull it off? Well, it all starts with the first of our three key decisions, the investment decision.
This is the million-dollar question, sometimes literally. A company sitting on a pile of cash. Now what? Does it build a new factory, launch a new product line, maybe upgrade all its tech? It has to decide which of these projects are actually worth the money. The goal is to pick the ones that will generate the most bang for the buck. And a super powerful tool for this is something called net present value, or NPV. It's a brilliant method that basically answers the question, what is all the money this project will make in the future worth to us right now? So first, you forecast all the cash it's going to bring in. Then you pick a discount rate. Think of it as the return you'd expect from a different investment with similar risk. You use that rate to shrink all that future cash down to today's value. You add it all up, and if that final number is positive, boom, you got a winner. Go for it. And here is why NPV is so essential. Other methods, like IRR, they give you a percentage return. But NPV gives you a hard dollar amount. It tells you exactly how much wealth a project will add to the company, in real money. I mean, think about it. A 20% return on a $10,000 project sounds great, but a 15% return on a $10 million project creates way more actual value. NPV cuts right through that noise.
Okay, this brings us right to our second pillar, the financing decision. Because once you've picked a winning project, you got to figure out how to pay for it. So where does the cash come from? This whole decision is about finding the perfect mix of funding to fuel the company's growth, but without taking on way too much risk or, giving away the farm.
A company basically has two main roads it can go down. First, there's debt. Think bank loans or issuing bonds. This is often cheaper because the interest payments are tax deductible. But here's the catch. You have to make those payments, whether you're having a good year or a bad one. The other option is equity, selling off little pieces of the company or shares. This is less risky for the company for sure, no mandatory payments. But it costs more in the long run, and it waters down the ownership for everyone who already owns a piece.
This actually leads to a really fascinating idea called the pecking order theory. It basically says that companies don't just pick their funding at random. They have a preferred order. They will always try to use their own cash first. That's their retained earnings. If that runs out, then they'll go out and get debt. And only, and I mean only, as a last resort, will they issue new shares and bring in new owners.
And that preference for using their own cash first? Well, that leads us perfectly into our third and final pillar, the dividend decision.
So let's say the investment's paid off. The company's making good money. It's a great problem to have, right? But it comes with a massive choice. What do you do with all that profit? The company has two options. It can retain the earnings, basically plow that money right back into the business to fund even more growth. Remember that pecking order? This is option number one. Or it can pay that profit out to its owners, the shareholders, as a cash dividend.
It's a direct reward for believing in and investing in the company.
Now, this decision isn't just about moving cash around. It's about sending a powerful signal to the world. A steady, reliable dividend tells investors that the company is healthy and stable, and that's exactly why cutting a dividend can send a shockwave through the market. It screams that management might be worried about the future, and that can totally tank investor confidence and the share price along with it.
Okay, let's pull all three of these together now. The investment, the financing, and the dividend decisions, they don't happen in a vacuum. They are deeply, deeply connected in what you can only call a great balancing act. I mean, just think about how they're all linked. You decide on a huge new investment? Well, now you have to make a financing decision. And if you choose to take on a ton of debt to pay for it, you might not be able to afford to pay your dividends down the road. But on the flip side, if you're known for paying out really generous dividends, you're going to have less cash on hand for that next great investment opportunity. It's this continuous cycle, and the whole game is to find that perfect, delicate balance that maximizes wealth in the long run.
And this high-level juggling act, it has a direct effect on the day-to-day grind. It all drills down to managing something called working capital. That's the money you need for daily operations, paying suppliers, keeping the lights on. It's truly the financial lifeblood of the company, and it requires its own careful balance between having enough cash to operate smoothly and using that cash effectively to stay profitable and grow.
And so these three decisions, investment, financing, and dividend, they're so much more than just corporate buzzwords. This constant balancing act, happening in boardrooms all over the world, is what shapes the companies we deal with every single day. It influences the products that end up on shelves, the jobs that are available, and really the health of the entire economy. So the next time you see a company make a big announcement, ask yourself, which of the three decisions are they making and how does it fit into their great balancing act?